Great seeing you here again. My name is Luc de Custer, founder of the Custer Academy. And in this new video, we're going to talk about the internal rate of return. But before we continue, don't forget to click on the subscribe button, click on the bell button, and every time we have a new video, YouTube will inform you about it. Let's have a look at the formula we defined before when we calculated the net present value. And when we have the net present value, we discount all the future cash flows by dividing them by the interest rate, or 1 plus the discount rate, the interest rate that we consider, and finally we subtract the initial investment. When we do that for different discount rates, what we see is that we have a function where we have different values of the net present value as a function of the percentage. And there is a point here where the net present value becomes equal to 0. And when we look at this point, we see that the discounted cash flows compensate exactly the initial investment. It's a kind of a break-even point. All the future cash flows compensate exactly the initial investment that we have done at the beginning of the project. What we can also define here, that this percentage, we call this the internal rate of return. And the internal rate of return is a yield. The yield that your investment will bring. And that's very important to understand, because when we invest money, not only the value of the net present value is important, but also we have to ensure that the yield of our investment complies with the standards of the company. We have to compare that internal rate of return with the cost of money. We will talk about that later, but first we're going to do an exercise how to calculate the internal rate of return. Let's have a look at a simple example. I have an initial investment CF0, the cash flow at the beginning, which is 6,588.31 euro. I've chosen this number because it gives a very good result in the calculation here. Now what we have now, we have a cash flow in the first year of 2,000 euro, the second year we have 2,500 euro, and in the third year we have 4,500 euro. Now when we look at the percentages and we calculate the net present value, we see when we have a discount rate of 0%, the net present value is 2,411.69 euro. Well, that's basically the sum of those three cash flows minus the initial investment. We don't have any discount rate, so we just disregard basically the time value of money. What we do now is we calculate the net present value for different discount rates. We took 10%, and you can do the exercise very easily. You take 2,000, you divide by 1 plus 10% to the first power, plus 2,500 divided by 1 plus the 10% to the second power, and for the third one we take 4,500, we divide by 1 plus the 10% to the third power, and we subtract the initial investment. And we find a net present value of 676.9 euro. We do the same calculation, and you can stop the video here, find the value, and what we do, or what we see when we take 20% as a discount rate, we see that the net present value becomes negative, and we find minus 581.37 euro. This means that the internal rate of return would be between 10% and 20%. And what I do, I just take the average of those two, which is in fact 15%, which is our next estimate of the discount rate, next estimate to find the internal rate of return. And what do we see? In this exercise, this is 0 euro. So it means that this is the internal rate of return. Basically, that's what we're going to do. We're going to find ways how to estimate the next closer discount rate, the closer discount rate approaching the internal rate of return. And that's what we do. Basically, we try for more discount rates, and we have a method where we estimate always by taking the average of the two discount rates, where the first one is positive, gives us a positive NPV, and the second one gives us a negative NPV. And between those two, we have a new approximation of the internal rate of return. The numbers I've chosen here have been such that we exactly find an internal rate of return which is equal to 15%. You see, it's not so complicated, but the fact that you may have a lot of cash flows, a lot of calculations may be necessary to find that value. Finding an estimate is not so difficult. We just calculate the net present value for different discount rates in a table, and we see where approximately the internal rate of return will be. We can use a mathematical method by approximations, and every step we come closer to the internal rate of return. Now, in reality, this may be a lot of work, and it may be more interesting to use the built-in formulas that are available on your financial calculators or in spreadsheet programs or dedicated programs which will do that for you. However, in some cases, when the iterations are too many to reach the internal rate of return, you may want to select an estimate which is close to the internal rate of return, which will improve or make the calculations faster. So that's it for calculating the internal rate of return. It's a very important concept in finance, and we will use it later to estimate if our project is a good project. How will we do that? We will talk about that in the next videos. That's all for this video. Thank you, but don't forget to click on the subscribe button, click on the bell button, and every time we have a new video, YouTube will inform you about it. Thank you, and I'm looking forward to seeing you in our next videos. Bye bye.